joined. I'm a certified financial planner here at Illumination Wealth, also one of our traders, and Heidi, also a certified financial planner here at Illumination Wealth.
Steinar, when previously you froze before introducing the webinars, and
Perfect. Yeah,
today's
let me
part
jump
three.
back to that. Yeah, thanks, Heidi. This is
Mm-hmm.
part 3 of our investment education series, geared mostly towards teens and young adults, but it can be great investment knowledge for anyone who's interested in the topic. Today, we'll be talking through asset allocation and risk management. Um, We'll also talk a little bit on alternative investments and what those look like. Our game plan today is a quick 45-minute conversation, go through of our content, and then have some time at the end for anyone to ask any questions that they may have that come up throughout our presentation today. So if you think of anything in the meantime, you can use the Q&A button at the bottom to ask a question or two, and we'll try to answer it at the end. We'll also have a couple of multiple choice questions and polls throughout our conversation today, so feel free to answer those as well. So now let me pass it over to Heidi to talk over our agenda and what to expect from today's conversation.
Thanks a lot, Steinar. Nothing like a few technical glitches to make it real and keep it real, right? Um, Thanks and welcome, everyone. Today we're going to go over a few topics. The first we're going to talk about asset allocation, just generally, what is it and why does it matter? And then we will go into explaining the core asset classes, and then talk about how to build a balanced portfolio and what that means. Um, and then understanding investment risks, the role of time horizon, which we'll spend a bit of time on because it's a really important concept. We will talk about alternative investments and then give you a brief introduction into behavioral finance. There's going to be a session on that next, so we'll keep that one brief. And then we'll go over some action steps and have some time for your questions at the end.
Perfect. Let's start off today with a quick poll question. And so this is just on a scale of 1 to 5, 1 being on the low end. I don't like to take a lot of risk. 5 being on the high ends. I'm a huge risk taker. Where would you say that you would put yourself at? So I'll give a couple seconds here to let everyone answer that. And we'll come back to this at the end of the presentation. So remember what you selected, and we'll come back to this at the end. But I'll let Heidi take it away, starting with our first topic of asset allocation and why that matters.
Okay, thank you. So what is asset allocation? Why does it matter? Asset allocation is the distribution of investments across different asset classes. It matters because investing involves risk, and asset allocation helps to mitigate risk through diversification. So what does all of that mean? Well, I can boil it down to, and no pun intended, but eggs. Don't put all of your eggs into one basket. I think everyone has probably heard that expression. If you fall down the stairs while holding that basket of eggs, you're likely to break many, if not most, or all of your eggs. Hopefully not in addition to some bones as well, but we won't talk about that here. We're talking about eggs. So if you distribute your eggs among many baskets and carry one basket down the stairs at a time, if you drop a basket, the rest of your eggs are still secure. And similarly, you can hedge your investment risk by allocating funds into different asset classes so that you don't lose all of your money when your investment experiences a big drop in value. So, I mean, investment is risky, and we're not saying that risk is necessarily bad. It's the price you pay for growth, and it needs to be managed. So what that looks like in a nutshell is that instead of putting all of your money into the stock market, for example, you allocate a portion of your money into different asset classes such as bonds, real estate, or alternative investments to help hedge your risk, and all of your investments and eggs will not be in one basket. So now I'll turn it over to Steinar to talk more about the different asset classes.
Yeah, as Heidi mentioned, a couple of those different asset classes. And if you attended one of our previous webinars, this might be a review for you. But in any case, we can start with stocks, which is, one that most people have heard of before. It represents, a small slice of ownership in a company. This is typically seen as a higher risk investment, but at the same time, there's that potential for a higher return as well. What complements stocks really well is bonds, which are usually seen as more stable, fixed investments. What a bond is essentially lending money that pays you a fixed interest rate over time. There's lower volatility than stocks, and all that means is it's not going to go on a roller coaster as much. It's more of a slow and steady investment that complements those stocks really well. We also have cash. And cash is interesting because a lot of people don't necessarily see that as an investment, but it's a super important part of anyone's investment portfolio. It's very low risk. There's, usually really low returns with it as well. But it's the safest investment out there that's, typically good for those short-term needs, from now till a year or two from now. We also have real estate, which most people know as, buying homes, buying property, buying land. These are typically seen as moderate risk and a hedge on inflation. And we'll get into inflation risk in a little bit here as well and explain that a little bit more in depth. And then finally, one of the topics of today's conversation is alternative investments. And these are typically seen as, not very liquid, which means they're harder to buy and sell, a lot riskier. With that, they do have, higher potential return, but risk is something that we're going to talk about too and how to manage that. A couple examples here are commodities, gold, crypto, private equity, private investments, running a business, things of that nature. So we're going to kind of take these core asset classes and use these to talk about, what is a balanced portfolio and why is that important?
Thank you, Steiner. A balanced portfolio is one whose mix of asset classes is designed to help you meet your investment goals, given your time horizon and your risk tolerance. So let's break that mouthful down. When we think about building a balanced portfolio, the best place to start is by considering what you're saving up for. It could be a car, a down payment for a house, or retirement. Steiner has been kind enough to share what he is saving for.
Yeah, one thing that's important to me is retirement. And while that may be 20, 30, 40 years down the line, we'll talk about how important it is to start early. But I'm, doing my future self a favor and starting early to invest for retirement now.
Um, let's see. Okay, sorry. Let's see. All right. So, yes. So the what will determine what you have to save money for. Or I'm sorry, will determine when you need to have the money. So for a car, you might be looking for a year or two, and for a down payment, that could be 5 to 10 years. Steiner, what time frame would you say that you're looking for, that you're looking at for retirement?
Yeah, for me personally, it's going to be, at least 20, 30 years down the line. And also something that, retirement money should last through, the end of your life. So it could be even longer than that. But on the low ends, it still is a very long time horizon for me. And as you have there, like because of that, I can take, probably a little bit more risk than, somebody who's 5 years away from retirement or is, going to retire next year.
Great points. And as you can see, these three different investment goals have wildly different timelines requiring different investment strategies. So the longer your time horizon, the more risk you can afford, as Steiner mentioned. So we'll go into those into detail with those examples shortly, but first I want to talk about risk. With consideration to risk, the questions that you want to ask yourself are how much risk you're comfortable with and how much you can afford to take. So comfort level is a personal thing unique to your personality. Steiner, how comfortable would you say that you are with risk?
Yeah, I would say I'd put myself on the higher end of the risk spectrum. So if we go back to that very first poll question where we had 1 to 5, one being the low end, I'd probably put myself at a 4 or 5, especially
Okay.
for something like retirement that's, further along the line for me than it is for somebody else.
Okay, great. And you seem really comfortable with that answer, and that is a key. You shouldn't assume more risk than allows you to sleep peacefully at night. And so that's something to think about. And there are quizzes that can help you determine that, and also just reflection and knowing yourself. And we'll get into that a little more a little bit later as well. The second component of risk relates to your financial capacity, how much you can afford to take. So a higher capacity for risk would be, if you have an emergency fund, for example, or a very high income, then you can weather more risk because you have a cushion. On the other hand, if you're carrying high interest debt, like, credit card debt that you have trouble paying off, or, you're just, yeah, that's taking up your excess money right now, then you're better off not taking on a lot of risk that could add to your debt burden. So once you've considered all of these factors, your investment goal, your time horizon, and your risk tolerance, then you have the information that you need to compile a portfolio mix that's suited to your needs. And this is where we'll now start talking about a balanced portfolio. It's one that suits your needs and allows you to meet your goals. I have this image here where on the left side is a sphere that would represent the riskier investments like stocks and commodities or other alternative investments. And on the right side, this sphere represents the conservative investments like bonds and CDs and cash, and this is you here in the middle. So while this is perfectly balanced, it would be a 50% allocation. But for someone like Steinar, who is willing and able to take more risk, this sphere here would be shifting to the left because he has a heavier weighting on the riskier investments. It's also important to note that how you allocate your assets is not static. It will change over time once you move into new life stages and gain more financial stability or set new goals. So, yeah, basically a balanced portfolio. It's not about symmetry, but stability.
Yeah, and let's dive into a little bit more risk and what we mean when we talk about risk. So every time you invest, essentially what you're doing is putting your money to work. The big problem though is that no one can predict the future, and that's where the risk comes in. So I get this question a lot actually, where people ask me, what are my predictions for the stock market over the short term, medium term, long term? And I like to say that my crystal ball is broken, and no one really knows what's going to happen. The stock market might go down, real estate prices could drop, interest rates could change. That's a big topic in the news right now. The government could create new rules, new regulations. But the big thing here, and going back to our, building a balanced portfolio, is when you own all these different kinds of investments, you can reduce your overall risk. And this just goes back to, diversification, like Heidi said, not keeping all your eggs in one basket. It's good to spread things around to not have too much risk in one type and one set of investments. And there's also quite a few different types of risks. So I'd like to take just a little bit of time to go over a high level of different types of risks that we have. So we have market risk. Essentially, market risk is just the risk you have for investing in the market. Stocks and bonds can go up, they can go down, they can stay flat. Um, that's just part of playing the game. We also have inflation risk. Inflation just refers to the rising cost of goods and services over a period of time. These rising prices reduce how much your dollar today is able to buy. So a big goal of ours with investing is to keep up with inflation and even go above and beyond inflation. Then we have interest rate risk, which is essentially just changing interest rates. The Federal Reserve sets interest rates, which can affect mortgage rates, can affect bond prices, can affect other investments. So that's a big risk to, take note of. We have credit risk, which is typically specific to companies, just meaning that they might not pay back their loans, which can have a negative impact on your investment in that company. We have liquidity risk, and all liquidity means is how easy it is to buy and sell something. So something that has high liquidity means it's really easy to buy, really easy to sell, where something with low liquidity isn't the easiest to, get out of or buy more of. We also have currency risk, which typically is associated with foreign investments. They can lose value based on changing currency with the US dollar or whatever dollars you are investing in. We also have political risk. We touched a little bit on this earlier about, the governments can, make new rules, make new regulations, in a positive or a negative way for investors. And finally, going back to our diversification is concentration risk, which is, an investor having everything invested in one company, one asset, one stock, whatever that may be, and just really trying to avoid that and spreading the wealth around so you're not overly concentrated in one investment. I did want to throw up a poll question here is looking at these investment risks. Um, is there an example from any of these risks that we've just talked about that you've seen recently? This may be something in the news. This may be something you talked about at school or with a friend. Um, there's a lot going on in the world right now where politically, financially, there's, been a bunch of risks. So I'll give everyone a couple seconds here to put in some answers here and be happy to share them. And Heidi, in the meantime, would you like to explain any of these that you've seen?
Sure. Two that really pop into my mind for this year are earlier in the year, we saw some market risk and political risk with the talk of tariffs. And I know, Steiner, in your world with trading, that you got a lot of questions about that during that time. Um, how was
Yeah, we
that?
yeah, we had a lot of clients just like reach out to us of, what are our thoughts? And initially it's always been like we talked about sticking to your investment plan, not getting too emotionally tied to any of this, and just, realizing that there are going to be risks with investments and just, sticking to our investment plan that we have.
Yeah, and the other one that we also saw this year is just a new administration bringing in political risk. And that just happens every time we change presidents. So that is an example of political risk.
Great. And we did
Um,
get a couple answers in that I want to share. So we have market reactions to the Fed's interest rate decisions. That's a really good one. There's a
mhm.
lot of back and forth on, should we cut rates? Should we keep rates where they are? They're trying to balance, cutting rates and keeping inflation low. So that's a really hard, thing to keep in balance. We also have an example that is a specific stock. So Hims is a pharmaceutical company, and they had a significant drop yesterday when they lost a pharmaceutical contract. So that's just a risk specific to that one company, but something that, can happen to any investment depending what it is.
Sounds like we've got some people in our audience who are paying attention to stuff going on right now. That's a really good
Definitely,
example.
definitely.
Okay.
Great. We
So
can
that
jump
was,
to um, more talk on risk, but this is more geared towards tools for managing risk. So, managing risk is all about understanding your exposure and aligning your investments with your goals and your risk tolerance. So, there's a couple main points that we want to make here. One Heidi already mentioned is knowing your risk personality. So, everyone's is going to be different. And the main thing here is can you handle market swings without panicking? So if you're someone like me, as I mentioned, if I'm saving for something that's 20, 30 years from now, I'm okay with short-term dips. It's not going to matter for me in the long term when I have so much time to make that back. But if you're someone who's close to retirement or you have just a shorter term goal, knowing these market swings can have, an impact on how you feel about risk. Another thing that we mentioned before as well is just diversifying your portfolio. And this can be across different asset classes. So this can be having stocks, bonds, real estate, cash. And this can also be diversification within these different asset classes. So you can have US stocks, you can have international stocks, You can have corporate bonds, treasury bonds, foreign bonds. There's ways to diversify within an asset class and not just own different asset classes. The other important thing that we're continuing to hammer home is knowing your time horizon. So, like I said, you want to think about when you're going to need this money. Is the short-term money, medium term, or long term? And finally, just avoiding behavioral mistakes. One of the hardest things to do as an investor is keep your emotions in check and stick to that plan. It's a lot easier said than done, and something that a traditional investor probably struggles the most with compared to anything else. It's really hard to keep your emotions in check when you're getting a lot of information, especially in these days where it's almost instantaneous. So it's always important to, keep your emotions in check and really avoid those behavioral mistakes.
Okay, next we're going to talk about why time matters in investment. So your time horizon is the amount of time you need or you plan to hold an investment before you need to access the money. This slide helps to illustrate the importance of time when it comes to investing. What it is a timeline of market crashes and dips, and it shows how, in spite of many market dips over time, which is represented by this red, you know, bumpy, craggly line, despite that, over time, the stock market has tended to grow, as you can see from this upward trend of the blue line. And what we take from this chart is that with a long enough time horizon in any given year with a dip, the market has not only recovered but continued to grow over time. Similarly, for any of the dips, a certain period of time is needed before the market has recovered in the past. Sometimes that period is very short, like like this, this looks like about year 2005. You see a little tiny, red here, but it's very short, and then it moves back up. So that's a very short dip. And sometimes it's lasted years, like this period from 2000 to about 2013, where you see a lot of significant ups and downs. It's hard to say how long a dip can last. We can have some guesstimates, but it's really hard to say. And so that's why shorter time horizons are for playing it safe. We can give an example here of a car purchase. If you have a short time frame, like 2 years to save, say, $25,000 for a car, and you want to buy that car at the end of 2 years, that's a relatively short time frame. And if we look again at this year 2000, if you had invested all of that money into the stock market, over the span of 2 years, the market was basically just, you know, declining. And so at the end of that 2 years, it looks like you would have lost something like 20% of the value of your savings or your investments. And with hindsight, we could see that it would have taken many more years to recover that. And so that would not have been a good place for investing your money to purchase a car within two years. Instead, to ensure that your money would be there when you needed it, it would have been better to invest in something that didn't subject you to the wild swings in the market, like a short term certificate of deposit that would guarantee that you'd earn an interest rate and virtually guarantee that your money would still be there. On the other hand, if you're saving for retirement, having something as long as a 30-year time frame completely changes the picture. With that much time, the stock market is a great place to put your money because it allows you to benefit from long-term growth and compounding. So if Steiner were to invest for his 30-year time horizon, say in 1990, um, after 30 years, we would be in 2020, and his portfolio not only would have weathered through this 13 years of significant ups and downs, which is referred to here as the lost decade. That sounds very grim. But over that 30-year period, he would have experienced exponential growth in spite of those shorter term dips. So risk, again, isn't necessarily bad, but it needs to be managed. And we've been fortunate that over this 150-year time horizon, we've experienced just growth in productivity, in technology, um, with the industrialization that has kept the market growing over time.
Yeah, I have a quick
Um,
question actually, Heidi.
uh-huh.
With those CDs, like you said, right now you can probably get a guaranteed 3 to 4% interest rate. I guess why wouldn't somebody, do that for that guaranteed return?
So that's a great question because I think because of the word guarantee, that's very enticing to think that, okay, well, forget these dips and severe downturns. I just want to know that my money's going to be there.
Right.
That thinking makes sense. The problem is that we also have inflation, which increases the cost of things, and the average annual inflation over the last that 30-year period we talked about was 2.4% per year. So over that 30-year time frame, the return that you would get with a CD or something that guaranteed that your money was there would actually cause an erosion of the value of your investments because of inflation. And also, you would have lost out on the overall stock market growth for those reasons that I mentioned before, just progress in technology and productivity and efficiency that would have generated or that did generate an annual average return of 10 to 11% per year during that 30-year period. So that's a really great question. And it's just to convey to young adults in our audience today that with decades to save and invest, you can really take advantage of a longer time horizon. Yeah, there you go. And then as you get closer to the end of your time horizon, gradually you would want to shift to more conservative investments. Your interest would then probably shift more to capital preservation than growth. So it's not static, and that is also, something to bear in mind. Things change. Your goals change over time.
Yeah, let's continue to talk a little bit more about time as it relates to total returns. And so what this graph is showing here is stocks are the green bars, bonds are the blue bars, and that gray bar is a combo of the two of what we see as a traditional 60-40 portfolio. And what this is showing is over shorter time periods, like the 1 year time period, there can be a very large variety in what they could return. As you see here with stocks, is it could be minus 39, 40%, even more, all the way up to, a huge gain of 30, 40, 50%. But as time goes on, these bars are getting shorter and shorter, just meaning that the volatility isn't as bad and you can expect, a smaller positive return over a longer period of time. So this just goes back to our point on, knowing your time horizon and what you can handle. So if I'm investing for something that's a year or two away, it's really difficult to put a lot of money in stocks because I don't want to lose half my money in over the course of a year or two, which could definitely happen. As opposed to something over 20 years, if I'm not investing that money, I'm missing out on some potential really good growth of 10, 15, 20% even over long periods of time. So we just want to continue to hammer home the fact that your time horizon really matters and what you're investing in can have a wide variety of potential returns.
Yeah. So the takeaways are that time smooths out the risk, and investment and patience tend to be rewarded. And so what you want to do is match your investment horizon with the investments that you make to generate the funds that you need, which, was the car example and the retirement example. You want to match to your time horizon. How to turn $100,000 into $1 million. A way to capture people's interest, I hope. But we do that is by leveraging the power of compound growth, which we've touched on, but it's such an important concept that we wanted to dedicate a slide to this. So basically what this slide illustrates is the power of compound growth, and here's how it works. The example is if you invest $10,000 a year for 10 years for an annual 8% annual growth return, sorry. At the end of that 10-year period, your investment would be worth about over $150,000 for a total $100,000 investment. So if you keep that money, that initial $100,000 invested, and continue to generate an 8% annual return, in 25 years, the funds that you initially invested would be worth just under $500,000. And in another 10 years, they would be worth over $1 million. This is basically due to compound growth. It's basically the snowball effect of earning a return on your initial investment, plus all of the subsequent earnings on the returns that you would get each year. So you keep the initial investment in there, and then you keep reinvesting the subsequent returns on those investments. Um, this is, we're trying to illustrate a point here. And you might say, oh, I don't have $10,000 a year right now to invest every year. But this compounding works, doesn't matter the amount. It might not turn into $1 million depending on what you invest, but the compounding will still happen if you are consistent and invest for a consistent return. There are calculators that will also help you do some planning to see what your money might be worth if you invested $10 a month or $1,000 a year. And so, we can talk a little bit more about that later. But it's a good, site setting tool and a planning tool. And bam, I just had to show that a little effect. Um, anyway, moving on.
Yeah, let's switch gears a little bit here, talking about other kinds of investment. So I'll launch a poll question here that is, what are other investments that you may know of? We talked a little bit already about traditional assets, stocks, bonds, cash. There's a lot of different types of investments on here. We'll talk about them in a second, but I want to give everyone an opportunity to answer and see, what are some other maybe not traditional assets or other just investments that you've heard of in the past. So I'll give everyone here another 15, 20 seconds and see what people have to say. All right, we have a couple answers here. Let me end this and view some results. Right, we have crypto. That's a big one that has become a newer investment. Like crypto wasn't really a thing 15 years ago, but it's gained a lot of traction recently. And we have another couple answers of gold and silver. Precious metals are definitely an alternative investment. And let's jump into, beyond stocks and bonds, what are other investments that maybe people didn't come up with? So first of all, beyond stocks and bonds are typically what we refer to as alternative investments. And these are just assets that fall out of the typical classes, stocks, bonds, cash. They offer pretty unique diversification potential. So as we talked about before, not keeping all your eggs in one basket, alternative investments are a great way to get out of, these traditional investments. They do have the potential for higher returns, but at the same time, it's balancing that again with risk. They're typically seen as more risky than those traditional stocks and bonds. Another thing about alternative investments is they're typically added to a portfolio later on. A lot of people don't really start off with alternative investments. It's typically after they have a significant amount of traditional stocks and bonds before they look into adding different types of traditional or alternative investments, excuse me. So let's get into a couple of those examples. So one of them is real estate, which is, one of the more common alternative investments. If I'm buying a rental house, I'm buying an apartment building, things of that nature. Commodities are another alternative investment. This could be gold, this could be oil, this could be silver, different things to that nature. Collectibles are another alternative investment. So this could be, rare artwork. This could be baseball cards. This could be stamps. There's a bunch of different collectibles that are seen as investments. As we just mentioned, Bitcoin, other cryptocurrencies are an alternative investment. And finally, private equity. And private equity is essentially just investing in private businesses or privately run funds that aren't available to everyone. So let's get into a couple of alternative investment questions. So let me pop up a question here. And we'll start off with a little bit of an easier one. Which one of these is an alternative investment? We have 1, treasury bond, 2, stock in a public company, 3, gold, or 4, a money market fund. So I'll give everyone a couple seconds here before revealing the answer. And this one, of course, is gold. That was an easier one. As we just talked about, gold is a commodity that a lot of people use as an inflation hedge. So let me share one more question. This one will be a little bit more difficult. And this one is, which of these is an alternative investment again? There may be more than one answer on this one. And here we have Microsoft stock, artwork, private investment fund, or a publicly traded REIT, which is a real estate investment trust. Give everyone a couple seconds here to answer as well. And this one's a little bit of a trick question. So as we know, Microsoft obviously is not an alternative investment. It's a publicly traded company that everybody can invest in if they want to. Artwork, as you mentioned, definitely is an alternative investment. It's seen as a collectible and therefore an alternative investment. A private investment fund is also another alternative investment. That would fall under that private equity bucket where it's privately investing in a fund that's not available to everybody. And the last one, a publicly traded REIT, technically wouldn't be an alternative investment, but it is a little bit at the same time because you are investing in real estate that is an alternative investment. However, the fact that it's publicly traded, it can, everyone can invest in it if they wanted to. So that's a little bit of a trick question. It can go either way. But just to get you thinking about, what alternative investments are and, good examples of them as well.
Great questions.
And finally, we'll just give you a quick rundown on traditional investments versus alternative investments and what are some of the major differences between them. And so the big thing is, as we mentioned before, diversification and correlation. And so what these two things mean are how closely related they are to one another. With traditional investments, two technology stocks are going to be really similar, correlated almost the same way, and won't give you that much diversification since they are both very closely related. However, those alternative investments, if you look at gold, if you look at Bitcoin, if you look at real estate, none of them are really related to one another. So that can give you, better diversification opportunities between them. When looking at risk and return, same thing with traditional investments is typically you'll see lower returns, but you can also have a lot less risk with that. So it's kind of this teeter-totter effect of, how much risk can I take? How much risk do I want to take? And then what's the potential return on that investment? And with alternatives, it's more so the opposite, where the potential for high returns is definitely there, but there's also a lot more risk that the investment may not pan out the same way as a traditional investment. Liquidity, we talked a little bit about before too. With traditional investments, it's really easy to buy and sell these. So I can go and buy Microsoft stock right now if I wanted to and have no issue doing that. However, with an alternative investment, they're not always easy to buy and sell. I think a great example of this is buying a house or selling a house. If you list your house on the market, you're very probably likely to not have someone show up on your doorstep that day and say, "Yeah, I'm ready to buy your house." These are things that take usually a longer period of time to buy and sell, which can be, you might get stuck with the investment or have a hard time, buying more of an investment. Same thing with fees. Traditional investments, typically don't have any fees, and if they do, they're pretty low transactional fees. Whereas alternative investments may have fees, such as, you're buying Bitcoin on exchange, it might be a 1 or 2% fee to buy it. You're selling a house, there might be realtor fees or other fees involved with that. Private investments typically have, a fee to get into that investment. So that's another just consideration to have when you're making investments with alternatives and traditional investments. And lastly, just regarding regulation, stocks and bonds are regulated by the SEC for the most part, whereas alternative investments may not have as much regulation, may not have any regulation. And it can be hard if, you're something you're investing in, you don't have a lot of transparency. This just might add to the risk. So those are just a couple of, things to think about when considering alternative investments in your own portfolio.
Steiner, is it important for everyone to invest in alternative investments?
I would say not at first. As we discussed a little bit before, alternatives definitely do have their place in a portfolio. But most people, it makes sense to start off with those traditional investments, especially when you look at, kind of the liquidity and fees aspect of it. It's easier to buy and sell and just, get started with those traditional investments and not have to worry about, paying fees for your returns. Whereas those alternative investments, they might be harder to get into. Some of those fees might eat away at your earnings. And just to start off with, those traditional investments make a lot more sense for a beginner's portfolio.
Thank you. Makes sense. Okay, so now we're going to move into a brief introduction of behavioral finance. Behavioral finance is the study of how emotional factors affect decision making. So, investor psychology can be led by emotions such as fear of missing out, greed, and overconfidence, and they can all impact investment decisions. Building good investment habits early can help the management of emotion-driven decision making. And staying the course, avoiding market timing, and exercising discipline tend to generate the best results in the long run. Those are kind of the three points that we wanted to make on this. And the way you can manage the psychology around investing is to develop an investment strategy and plan that you're comfortable with, and that can help you keep your eye on the ball. Here are some simplified steps of what that might look like. So, and it also kind of summarizes some of the stuff that we talked about. So the first step would be to determine your investment goal. For example, saving for retirement. And then determine your time horizon. Steiner's time horizon is 30 to possibly even 50 years. And then next step would be understanding your risk tolerance. Reflect and determine how much risk you are comfortable with and that you could afford to take. And then with all of that, putting together an investment strategy. How much can you invest each month? How will you allocate those assets? And those are, again, very simplified steps. It's more, more in depth than that, but just to get the point across, once you have those steps done, and then you have an investment strategy and plan, that will help you to stay the course, exercise discipline, and keep focused on your plan. And try to put blinders on when you see or hear about these dips in the market or stocks going up and down. You do want to revisit your plan periodically, but try not to be distracted in between. And with all of that, I know it's easier said than done, right, Steiner?
Right. Yeah, like we said, with especially those, the fear, the greed, missing out. It's really hard as an investor to kind of tone all that noise down and not worry about that and stick straightly with your plan. But we'll have a lot more on this, like you said, with our next webinar. And so there's a lot of different things to think about when it comes to investing.
Oh, okay. So we're going to summarize what we talked about today and give you the big takeaways that we think you should take.
Yeah, like we said, investing always comes with at least a little bit of risk. Like we said, it's also not something that's necessarily a bad thing. It's just something that we always need to be aware of and that needs to be managed. With that, diversification is a huge tool to hedge against risk, all those types of risks. So don't keep all your eggs in one basket. Spread it out around stocks, bonds, cash, different kinds of stocks, different kinds of bonds.
Oops,
Can't go wrong with that.
got a little excited there.
No worries. And lastly, with alternative investments, is they can definitely have their place in a portfolio, but it's, important to think about their own set of risks that come strictly with alternative investments in addition to those traditional investments that most people own as well.
Thank you. And again, a balanced portfolio considers your investment goals, given your time horizon and risk tolerance. And you can reap the rewards of a longer investment horizon by starting to invest early, which is a very, that speaks hopefully to everyone here because most of you, all of you, have the benefit of time. And building good habits, good investing habits early will help you to avoid emotion-based decision making.
And we want to leave you here as well with a couple of action steps for you to do as takeaways from our conversation today. So one of them is taking a quiz to determine your risk tolerance. So this goes back to our first poll question there of scale of 1 to 5. How risky are you, would you say? And so after today's conversation, that might have changed. Either you might feel like, yeah, I might be able to take on a little bit more risk, or it might be the opposite, where you might feel that, you're taking too much risk already. You might want to tone it down a little bit. So there are a couple of good online resources if you just, do a quick search on risk tolerance quizzes. There's a bunch of different, good websites from like Schwab and Edward Jones and other advisor websites that have examples of these for you to take. So I would encourage you to do that. Another thing would just be to explore other alternative investment topics. So we talked about a bunch of those today: real estate, Bitcoin, crypto, commodities, like gold and silver. It's just to do more research on those and see, if that's something that you may want to invest a little bit in now or even in the future. Another thing is going back to, Heidi's compounding growth. And, we use the example of $100,000 and what that can grow to. But like she said before too, what if we start with $10 a month? What if we start with $20 a month? And just, seeing how powerful long-term investing really is. And with that, taking action now and starting this now when you're young and able to do so, your future self will, definitely thank you for that.
All right. Well, we are moving into um, just the Q&A period, which we have a few minutes for. But before we move on to that, just want to let you know that, again, the next session is about the psychology of money. And if you're interested in knowing more in the meantime about investing, here are a couple of book recommendations that we can make. Um, and just so you know, these sessions are recorded in case you would like to come back and review any part of them again. Um, and now we will move on to the Q&A to see if anybody has any, oops. Um, yeah, if anybody has any questions.
Yeah, and you can pull up that next slide, Heidi. So if you don't want to ask any questions today or something comes up in the future and you want to ask us, here are emails that you can get in contact with both Heidi and myself. We'll be happy to respond and answer, any questions that you may have from today or from any other investment topic as you may be doing more research or learning about alternatives or whatever it may be. So let me look at a couple of questions we received. So one of these is, what explains the constant stock market upward growth over the long term? So this goes back to Heidi's chart of, starting down here and that continuous growth. While there are, a bunch of dips in the meantime, what really explains that, stock market upward growth? And what I would say is, just general economic growth, innovations. This could be increases in productivity, increase of the world just becoming more connected through trade and technology. Just the world and population growing as a whole as well attributes to that. So what we've seen over the course of a long period of time, and when in doubt, just zoom out and look at something like that. Over the long term, we'll continue to see, a long upward growth trend as time goes on. Let me see if there's any other questions. We have one other one that is, what would you say is the difference between saving and investing? Heidi, do you want to tackle that one?
Sure. Um, So usually when we talk about savings, it's really like we think about putting money into a bank account or a piggy bank. It might earn nothing or it might earn a little bit in a bank account. When we think about investing or when we talk about investing, we're really talking about putting your money to work by investing it into the various vehicles that Steiner went over earlier. The goal is to grow the money. And that's what we mean by making it work for you. So that's the difference between saving and investment. One is just kind of, you know, more of a, just you're putting your money somewhere where it's safe and you know it's gonna you're saving it and investing it. I guess the terms are kind of explanatory if you really think about it. Investing is putting the money to work.
Well, great. I don't see any other questions, so we can probably end just a couple minutes early today, but we appreciate everyone who tuned in and listened to our presentation today. Like we said, if you have any other follow-up questions or thinking of something right after the call, feel free to reach out to either Heidi or myself. And again, our next session will be in August. I'm going much more in depth than we did today on the psychology of investing. So we're going to encourage everyone to sign up and join that one as well. But we really appreciate your time today and hope that you have a couple of takeaways from today.
Thank you so much. It was great to have you, and I wish that we could see you, you could see us, but it's been great. Thank you.
Awesome. Thanks, everybody.
Bye bye.